What is up, guys? Welcome back to another video. Now today we're going to make something a little bit different. I have always really wanted to make a tier list. So today we are going to rank all of the stocks in my growth portfolio. I already put them all down here, and we are going in order of position size in my portfolio. So of course, when we are talking about growth stocks, the most important metric is going to be, well, growth. I'm not only going to look at historic growth because, I'm not paying for the growth of the past 10 years. I'm paying for the growth that is still in the future. So I'm going to look at past growth as well, but more importantly, how is the future looking? How likely is the growth going to continue or even accelerate? Reliability is also another very important factor. I want to have reliable growth. Profitability is also very important. Especially growth of profitability, so margin expansion, because it just means that the company has a moat, and this also helps for reliability, and it also is another driver of growth. So maybe they are growing their top line, their revenues by 12% per year, but they are growing their earnings per share or free cash flow per share by 14% per year because they can increase their profit margin. That's also a great thing to see. And lastly, we are going to talk about valuation. So given their current stock price, given the current market, do I think they present a good opportunity? If they are overvalued, I will rate them lower. If they are very cheap, then I will rank them higher. So this is more or less how I think about my current portfolio and the stocks in it, which of these I would like to buy and which I would not. Now, if you like this kind of video, then let me know in the comments down below, and I might also do a similar video for my dividend portfolio. I will probably include some watch list stocks there because the portfolio has very few holdings, but here it's actually more than I wanted to, so let's get into it. So let's go with Nvidia. Now, recently they had a pretty big run up. Say what you will about market timing, but I think I had a pretty good hand when it comes to Nvidia. I believe I first bought them here around March, and then during the tariff fear sell-off, the Liberation Day. So yeah, I brought it pretty good points, which is why I'm up quite a bit by now. And the stock has just been crushing it. Just year to date, they are up by 25% despite having a large drawdown. Quite impressive. So in terms of growth, I believe you should probably know that in terms of growth, there's hardly anything you could criticize them for. They have been a pretty great grower, especially since the whole AI data center evolution. But even before then, they weren't too bad when it comes to growth. They are also very profitable. They have very high margins, free cash flow margin of almost 50%, profit margin of over 50%. This is absolutely amazing, especially for a company that produces actual physical assets and not just software. So growth, absolutely check. Profitability, check. No issues here. Reliability, well, I'm not too sure about that actually. And it remains to be seen. As of right now, there's absolutely no signs of them slowing down. But I do have some doubts about the sustainability of the current CapEx cycle for the hyperscalers and for also lots of countries that invest into large data centers. Don't get me wrong, I don't think that they will necessarily decrease the amount they're spending, but I would be very shocked to see the rate of increases in CapEx to remain as high as they are currently. The reliability here could suffer a little bit. And in terms of valuation, I don't think they're terribly overpriced actually, all things considered. They are trading at below a 60 PE, which isn't cheap, don't get me wrong, but they're growing like crazy. So the forward PE is already at 37, which, it's not cheap again, but you're getting one of the best companies for sure, and a company that's growing like crazy. I personally don't want to buy right now because it's already the largest position in my portfolio. But if you don't own any shares, I don't think it's the best opportunity right now or the best moment to buy them, but I don't think they're terribly overpriced either. So all in all, I would put Nvidia as an A. I think A is pretty good. They get little deductions for valuation and reliability, and the rest is pretty much perfect. Next up, we have ASML, which recently became the second largest holding after they dropped down after earnings. Now, in terms of growth, we can see that, well, 10-year revenue CAGR of 18%, that's pretty great. EPS CAGR of 20% as well, nothing too bad right here. Profitability also looking good, free cash flow margin of 28%, profit margin of 29%, also pretty good. Now, one caveat right here is if you're looking at their free cash flow over the past 15 years in this case, we can see that it is pretty lumpy. This is simply because they, one, have huge expenses building their machines and doing research and development, and also they sell very few machines to very few customers. So there is inherently going to be some variability from quarter to quarter or even year to year. And in terms of valuation, let's just look at their trailing 12 months PE. So this is their price over their past 12 months earnings. And we can see that we are at an historic low point. In fact, there's only been another time where it's traded even a little bit lower during the tariff sell-off. But even then, it was pretty much the same PE. So you could say that over the past 5 years, ASML has never been cheaper. And this despite their business being about as good as it ever has been. Yes, there is some uncertainty about their revenue growth for 2026, but this is such a short-term thinking that I don't really want to entertain it any further. And so long-term, I believe that they are very undervalued, and this is going to be a very attractive entry point. So I think it only makes sense to put ASML right next to Nvidia in A tier. Next up, we have got Brookfield Corporation. Now, in terms of growth, I couldn't really find good stats on FinChat or any other platform, so I asked my good friend ChatGPT. And for Brookfield, because it's a more complex company than something like ASML or Nvidia or many others, because there are so many money flows going around in the company and it's not very representative of what the business is actually operating at. So what they are doing is they report distributable earnings, and especially what I care about is distributable earnings before realizations, which simply means that they exclude any large one-time payments they got for selling some real estate, for example. So this is just from their regular business operations, the distributable earnings, which is pretty much their free cash flow analogon. And what we can see from these numbers right here is that year over year there has been very reliable and also significant growth. So it basically doubled over the past 5 years. And with stable share count, we can see it here. The per share metrics are also pretty much doubled over the past 5 years. So this is pretty great. And while yes, they won't grow as drastically as Nvidia, for example, or some other companies like Palantir or some smaller companies that we are going to look at later, this is still, 15 to 20% growth per year. That's not too bad, really. Profitability is a little bit harder to assess right here, again, because the company is a lot more complex and it's not as easy as looking at, well, a net margin or a free cash flow margin. So we are just going to skip the profitability section and going right over to valuation. And as we can see, we have a market cap of around, let's say 100 billion for sake of easier calculation. And in the most recent earnings report, they reported around 5 billion, again, for the sake of easier calculation, around 5 billion distributable earnings before realizations. So they are around at a 20 multiple, which for a company growing 15 to 20%, they also said they expect to grow 15+% CAGR, I believe, for the next 5 or so years. And I have absolutely no reason to doubt them. And considering its growth, this is absolutely phenomenal. So all in all, I think this is probably one of the best companies in my growth portfolio, but I will deduct points because they are not growing as fast as some others. I can't give them full points for growing 15 to 20% if there's other companies growing 20 to 30%. So I will deduct some points here, but other than that, I think they get full grades. So I guess this might be a bit repetitive, but I will put them in A. Next up, we have got Amazon. Now, in terms of growth, this is probably the slowest or the most disappointing one out of the bunch that we have so far. Looking right here at the revenues, we can see that growth has slowed down to around 10% over the past few years, which isn't terrible, but it's not even significantly above the S&P 500 or the market. So at this point, this is only hardly even categorized as a growth company. Now, one of the largest contributors to their operating income is AWS, their cloud service, which is still growing faster than the rest of the business and is also higher margin. Therefore, I believe that the 10% growth is sustainable and might even expand going forward. But still, this is not as much of a growth company as some of the others. And also, if we look at their operating income, which I would say is the best proxy for profitability, because Amazon is run mostly break even, meaning that the cash flow they generate is invested back into the business in new growth avenues, which in principle is a good thing in my opinion, as long as they get a high return on these investments. So looking at operating income, we can see that it is not the most reliable, because we had this down phase here in 2021 and 2022. But over the longer term, it's still growing quite nicely. And again, AWS is going to contribute more and more to this operating income. And as long as they can keep growing AWS at, say, 15+% and maybe add some margin expansion on top of that, then I think their growth story is going to be just fine. In terms of price to operating cash flow, they are trading a little bit below 20, which historically is not really that cheap, not really that expensive either. It's somewhere in between. We had dips down to 15 and again 15 last year, and it's consistently had dips down into the 17-18 region. So I don't think it's too cheap and not too expensive either. Overall, I think this might be controversial, but I believe I will put Amazon into C actually, which is surprising even to me. I mean, there's somewhere between C and B, I would say. Maybe C+. But the growth is not that amazing. They don't have the same reliability that Nvidia and Brookfield, for example, have. They are not also nowhere as profitable because most of their revenues come from a low margin business, and they are not too cheap either. So I think, yeah, actually C is pretty fair. Next up, we are going to have a look at Alphabet, which is the parent company of Google. Now, in terms of growth, we can see that recently it slowed down a little bit. Over the past 3 years, revenue has only grown 10%, whereas over the last 10 years, that has been 18%. But on the other hand, EPS has been growing 20% over the past 3 years. So they have clearly become more efficient, and they were able to convert more of their revenue into earnings, which is always great to see. And also looking forward, they are expected to ramp up their revenue a little bit by 12%, up from 10% over the past 3 years. And also their EPS is going to grow at 15% according to estimates. So growth, again, it's not an Nvidia or anything, but growing 12 to 15% is pretty decent. I'm totally fine with that. In terms of reliability, over the past 10 years, we can see that free cash flow is up 330%. We also see that it has pretty much stagnated from 2022 until now, which is due to them investing huge amounts into CapEx for data centers. So here it makes more sense to look at net income, or I don't know if they even report this here. They don't. Operating cash flow would have been great. Let's see how net income does. Yeah, that's paints a clearer picture. Up a lot more, also not quite as lumpy. We see this little down moment here in 2022 and beginning of 2023 when most tech stocks sold off quite a bit. But overall, we get a rather reliable picture up and to the right, pretty much year on year. Now, the one blemish maybe on Alphabet is, of course, that their search business is supposedly under attack right now through LLMs and chatbots and all that kind of stuff. but they are still growing their search business, their revenue, their income from search by over 10% per year. So as long as they can keep it at a 10+% growth rate, or even, let's be reasonable, 8+%, think about it. They are generating so much cash from search, and they already have been on the market for so long, so you might say, okay, they have penetrated the entire market. If they can still keep growing at more than 8% per year, then I don't care what anyone says, they are clearly not being killed by ChatGPT or what have you. So I'm not saying it's not a threat, it certainly is, but as of right now, it hasn't been realized. And in terms of valuation, it's trading at a 21.5 PE, 20 forward PE, both of which look very attractive. Now keep in mind, Alphabet is not exactly known for trading at high valuations. Let me see if I can pull this up right here. I do like this website because even with a free account, you can still have quite a lot of data. Never mind then. We might not have that much data to work with. In any case, historically, Alphabet has always been a lot cheaper than you might expect, given its that market, the industry it's working in. Yeah, you can see it right here. So they peaked at what, 35 times year earnings, trailing 12 months earnings, which is pretty crazy as a peak for a company growing 15-20% per year, very, very reliably, high margins, absolutely great business overall. I don't know exactly what the reason is, why they are constantly trading relatively cheap compared to other Mag 7 stocks, but then again, just makes it cheaper to buy them. Overall, I would say they are fairly cheap compared to the overall market. They are trading at multiples below the S&P, but growing a lot faster, and also, I would say, a much higher quality company. But compared to their own historical values, I would say they are pretty reasonable. Now, over the past few months, you had great opportunities to pick them up at even a 16 PE, which is absolutely incredible, which is also when I bought it in large parts. So you had great opportunities. Now I think they're not gone, but it's not as good as the opportunities are not as good as they used to be a couple of months ago. All of that being said, I think Alphabet is going to be our first S stock. Next, we depart from all of our very large cap stocks that are very well known, and we go over to Nebius Group, which is a lot more under the radar. You can see that market cap only $16 billion, much smaller company that is heavily involved in AI data centers. They are a lot more, how would you say, speculative than some other companies on my list here, simply because, well, there's a lot of growth priced in. You can see that the price to sales, or EV to sales, is 64, which is pretty rich. It's not Palantir levels of rich, but it's still quite a bit. They are also not reliably generating profits. You can see that in the last year they actually had negative 640 million, so they lost $640 million. But the idea here is that this is a longer term growth play, so I would expect them. Actually, it says they have PE already. I'm not sure how that works with negative E. In any case, I believe that they can reach profitability in maybe 2 years or so. And their revenues currently are growing like absolutely incredible. Let me see if I can show you this. That's what I was talking about. This is the revenue chart. This is the total of 2024, $117 million. This is trailing 12 months. So this is the first 2 quarters of 2025 and also the last 2 quarters of 2024. And still they already increased the revenue by over 100%. So revenues are growing absolutely crazy. So in terms of growth, absolutely given. Reliability, so far they have grown very reliably. Profitability, that's the big minus. And valuation, I think that now, I'm not sure. It's very hard to value a stock if it doesn't have earnings. And also if the future earnings are not as clear as with some other companies. I'm not interested in buying any more stocks right now. I bought them when they were really cheap down here, somewhere in April, May or something like that. So I'm already up quite a bit and I'm happy with holding them, but I don't plan on adding any new shares. I don't think they are as attractive as they used to be. But of course, the company still has some potential, and I think there's worse things than buying stocks of Nebius right now. Of course, no financial advice or anything, but I could very well see them still doubling, tripling over the next couple of years. So overall, I would put Nebius in B tier. Next up, we have Microsoft. Now let me make this a little bit quicker. We have very reliable revenue growth, 12, 13, 14%. Earnings growing a little bit quicker than that because of margin expansion and some share buybacks. And we have great profitability metrics, 25% free cash flow margin, 36% net margin. We can also see that their net income over the past 10 years is pretty much as reliable as you could expect. All looking great. In terms of valuation, that's the one thing where I would certainly deduct points. They are trading at a 34 forward PE, which is not crazy expensive, but it's certainly at the higher end, I would say, even within overvaluation territory. So right now I'm not interested in buying any more shares, but they are a very, very reliable company. Overall, I am going to put them in B. Growth could be better and valuation could also be better, but other than that, nothing to complain about. Next up, we have Taiwan Semiconductor. They have also been growing absolutely incredible. Revenue growth 22% over the past 3 years, 15% over the past 10 years. Earnings per share 24% over the past 3 years and 17% over the past 10 years. We can also see from the net income chart here that it is fairly reliable. It's not as smooth maybe as Microsoft's net income, but still pretty good. We also have very high margins, 27% free cash flow margin, 42% net margin. Absolutely great. Similar to Alphabet, they are also perpetually at a very low valuation. We have only a 21 PE. It says it has forward PE of 4. I'm not sure. Must be some glitch, some wrong data here, because I don't think their net income is expected to quintuple over the next 12 months. That would be pretty incredible. In any case, it's fairly cheap. But of course, for TSM, I can understand it to a certain degree because of the whole China-Taiwan risk. So there is some margin of safety that is warranted in my belief. Still, I think they are fairly cheap and growing quite nicely and reliably and profitably. So I believe that TSMC is going to be our next S-tier company. The next stock on my list is going to be HIMS and Hers Health, and they might be, together with Nebius, the fastest growing company on this list today. Over the past 3 years, the revenue has grown by 75% per year. Over the past 5 years, 78%. That is incredible. 5 years of 78% revenue growth. That's really hard to come by. Pair that with now profitability actually. They are profitable, 10% net margins, 6.6% free cash flow margin. This is going to increase quite a bit over the next quarters and years because they have just now turned profitable, and so their margins should still be going up. Now there is a lot of uncertainty around the stock as well, so I would deduct some reliability points because of the whole GLP-1, Novo Nordisk, Eli Lilly, is it shorted, can they compound it, blah blah blah. You could make an entire 1 hour episode just about that issue. Long story short, there is some uncertainty and they might not grow as, or certainly won't grow as quickly for the next 5 years. I don't think we will see a 10-year revenue CAGR of 78%. That would be bonkers. So I would expect growth to slow down. And also there's some concern. There might be some trouble ahead. So I will deduct some points for that. Valuation wise, I don't think it's too expensive. We have a 65 PE for a company growing revenue at what, 50% or something like that this year. And earnings per share, let's say they're growing 60% because there's a margin expansion. This PE will drop quite a bit, quite fast. And something that is maybe better to value growth companies at, or very unprofitable or completely unprofitable growth companies, is EV to sales, which is at just below 6, which for this growth is pretty cheap. So overall, I would say growth, great. Reliability, so far so good, but I'm unsure about the future. Profitability, not the greatest, but improving. Valuation, pretty good. I would say it's between a B and an A. Let me put it in B, because there is some headwinds, or at least some uncertainty, potential headwinds, and it's not that cheap anymore. It has been very cheap over the past year or so. There have been great entry points, but right now, maybe not the cheapest. Next up, we have got New Holdings, which is a banking fintech company from, I believe, Brazil. Yeah, Brazil. And yeah, they have been growing quite well, actually. It says here revenue growth 76% of the past 3 years. So similar numbers to HIMS, actually, which is better than I expected. Their net margin is 38%, which is great. Free cash flow margin is not important for banking stocks. So great margin, great revenue growth. However, over the past couple of quarters, if we look at the revenue growth just here, looks great. This is over the past 5 years. It's more than great. It's incredible. However, if we look at the quarterly view, we can see that as of recently, it has slowed down and more or less stagnated. Not amazing, really. And this is one of the reasons I have considered selling them. Now they report earnings in the coming week, I believe. So I will wait for what they're saying during their earnings call and also look at their investor presentation very closely and maybe decide to sell at that point. So their future, so far they've been growing incredibly well. But it seems like over the past couple of quarters, there have been some headwinds. There's always some FX headwinds when you're dealing with companies in South America. If they could resume, maybe not the same growth levels as before, but some growth in the mid-teens, that'd be great in terms of valuation. 28 PE, 21 forward PE, that's not terrible. Really, it's pretty good actually. It says here that expected forward revenue, the expected EPS forward is 35% almost. I mean, if they can manage that, that's great. I have some doubts about it, but we will see. Maybe I'm too pessimistic about New, but I think growth so far has been great. Future forward-looking, maybe not so great. And over the past 1 year, it certainly hasn't been great. Reliability, again, same thing. If you would have asked me 1 year ago, would have probably scored an S. But since the last couple of quarters have been a little bit of a letdown, I would say C probably, yeah. Because if they continue on this current trajectory, then that's pretty bad. If they can improve it to the levels from 1 year ago, then it's great. Then it goes up to an A or something like that. But there is certainly some uncertainty right now, and it's just very hard to rank accordingly. Now we are looking at Booking Holdings. This company right here has been growing pretty well over the past couple of years. Almost 20% revenue growth over the past 3 years, 11% over the past 10 years, EPS 12% over the past 10 years. So this is, again, nothing as explosive as an Nvidia or HIMS or something like that. But of course, the company is also much larger already, so it's unreasonable to expect 50-60% growth. And for its size, I think it's still growing fairly well. In terms of margins, we have 37% free cash flow margins, 19% net margins, pretty good all across the board. And if we look at their free cash flow generation over the past 10, let's make it even 15, yeah, it's incredible picture. You will have to excuse this little dip here. This is because of COVID. I think that makes quite a bit of sense and can be excused because, well, if nobody is allowed to travel, how the hell is Booking going to generate any free cash flow? But other than that, the growth has been absolutely incredible, very reliable, very good growth, nothing to complain about. In terms of valuation, I think it's a little rich right now. It has really been cheaper before. like when I bought it and during the tariff sell-off. Right now, I don't think it's in the overvalued category, really. I think it's around fair value right now, but it's not a steal. So overall, I think this is another A. A is probably, yeah, reasonable place for booking holdings. Next up, we have got SoFi Technologies. They have also been growing quite nice, which is a common theme because we're talking about growth stocks today. Over the past 5 years, 43% revenue growth rate, pretty great. EPS is expected to grow 18% going forward, but then again, keep in mind that analysts are constantly underestimating SoFi. I don't really get it with SoFi. Like, generally, I think with many companies, analysts are fairly accurate, but for some reason, they always seem to underestimate SoFi. So for SoFi, I would always look at what management is saying, because even management is underestimating themselves. They always give guidance and then they beat it and raise it, and then they beat it and raise it again. I think that management guidance is probably a very good indicator of what the company is actually going to achieve. And historically, management has been fairly conservative and has always over-delivered. And management itself says that they are aiming at the midpoint around 70 to 75 cents of net income per share by 2026. And if we divide 22, which is the current price for SoFi stock, by, yeah, let's be pessimistic and say 70 cents, that's 31 PE for next year. And I think that's pretty fine for a growth company. They say that after that they still expect 20+% CAGR for the net income per share. So I don't think they are undervalued necessarily, but it's not as bad as it might seem because analysts for some reason still think that SoFi is a bad company. So growth, great. Reliability, absolutely amazing. Profitability, pretty good. Valuation, fine. I would say this is another A tier contender. Next up, we have got MercadoLibre, and they are notoriously difficult to value because they reinvest most of the cash back into the business, similar to Amazon, which makes the whole thing a little bit more difficult. Looking at their growth, absolutely incredible. 40% over the past 3 years, 44% over the past 10 years. That's incredible. Look, think about it. 44% per year over the past 10 years. Net income, 35% per year, also great. Looking forward, still expected to grow at above 30%. Free cash flow margin, not really applicable because they have a finance branch. So as soon as you've got like a banking or fintech stock, I wouldn't look at free cash flow. It's a little bit misleading. Again, net income is also misleading because of the way they run their company. So it's a bit more difficult to value them. So what I will do with them is look at them from a price to sales perspective, which would be similar to something I would do with a company that has no net income right now or is negative net income. And when you look at that, we have a 5 price to sales, which is pretty cheap for a company expected to grow 30+% per year. And it's also very reliable, has been growing incredibly for the past 10, 15, 20 years. So growth, absolutely great. Reliability, given profitability, difficult to assess, but I would say they could easily be very profitable. Valuation, also pretty great. I believe this is deserving of another S tier. Okay guys, I hope you are not yet tired of my voice because we have 4 companies left to go through. And the next one, this is my last somewhat major position because the 3 companies after that are very small positions in my portfolio. And this is Mastercard. They are probably about as reliable as you can get. We have 13% revenue growth over the past 3 years, also 13% over the past 5 years, and 12% over the past 10 years. We have EPS growing somewhere between 14 and 16%, depending on which time range you look at. We have incredible margins, 55% free cash flow. That means for each dollar they generate in revenue, 55% of that stays as free cash flow. That's great. 45% net margin is also absolutely incredible. Now, because they are more of a mature company, the growth rates are not astronomical, 12, 13, 14, 15%, somewhere in that range. So pretty good, but nothing exceptional. But again, it is made up by very high reliability, very high profitability. And in terms of valuation, this is one of those companies that is always pretty expensive. Their PE ratio is a 38. Let me see how that compares to their historic values. And yeah, as we can see, we had this small bubble burst here. But over the past 2 or 3 years, they have always been in this range of 32 to 38% at PE. Then again, 33 up to 40, down to 36, 36, sorry, up to 40, down to 34. So they're always in this range of, say, 35 to 40 more or less, and trading a little bit up and down. So yeah, I would say they are currently pretty much in the middle of that range, so fairly valued. No steal for sure, but also not terribly overvalued. I would give Mastercard another... Is it unfair to put them in B? I really like the company. They are very reliable, but their growth is not crazy and they're not too cheap. So yeah, I would say that's fair. Next on our list is Toast, growing revenues at 35% over the past 3 years, close to 50% over the past 5 years, phenomenal growth. They have also turned profitable, I believe last year, the end of last year or beginning of this year, I'm not sure anymore. In any case, they are profitable at a PE of 116, but because they can expand their margins quite a bit, at least that is expected, their forward PE is only a 41, which puts the whole thing into perspective. And given they are growing their revenue at 30% or so, a 40 forward PE with some margin expansion is actually, I believe, pretty cheap. They just also reported earnings, which I thought were absolutely great. There was nothing I didn't like about them. And they traded down a little bit after that, which was certainly a choice for the market to do, but I couldn't really get my head behind it. This is actually a company which I'm very, very close to making a larger position, maybe putting a couple of €100 into it and making it not one of my largest positions, but putting it in somewhere in the region of 4, 5, 6% of my portfolio, up from where it is now below 1%, because we have very high growth, pretty reliable. Profitability is still not great as of right now, but is improving. And the valuation is actually rather attractive. One of the cheaper stocks, I believe, on this list. So because they are not as profitable right now, I will put them in A as of right now. But if you have faith in them expanding their net margins to, say, 15% in 2 or 3 or 4 years, then this could easily be another S tier company. Then we have C Limited, which is somewhat like the Amazon or MercadoLibre of Southeast Asia, hence C. A company that is growing right now at a region of 15 to 20% in terms of revenue. However, they recently, I believe in 2023 it was, 2023, they had their first year of full profitability. And that means that I would also expect them to increase their margins over the coming years, similar to Toast and some other companies that we already talked about. Because currently the net margin sits at only 4.9%. This could easily climb a lot higher, which would bring their PE down a lot. Their forward PE already sits at a 33. So I would say their growth, it's not as great as Toast, for example. So I will deduct some points here. They could grow faster, but they are a lot larger company already. They are pretty reliable. Profitability is pretty bad still, but is improving. And I would expect it to go up even more. Although they also have a large e-commerce part, and we see with Amazon that this tends to not have the highest profitability or the highest margins. So there's some concern there maybe. In terms of valuation, it's pretty good, but overall I would say it's similar to Toast in all of these metrics, but just slightly worse. So I would put this in B tier. And now we have finally made it to the last company for the day. This has been quite a while for me. and this is Uber. Now, Uber has been growing their revenues at 22.8% over the past 3 years. Going forward, it's expected at 15, and that's also closer to what we saw in the last earnings report. So I would say 15 to say 18% growth is reasonable. We already have great margins, 26% net margins, although I believe there was some one-off event the past 12 months, which artificially increased their earnings and thus also decrease their PE, which makes them look cheaper than they actually are. So looking at price of free cash flow, I think that's more telling right now. We have 22, which is fairly cheap. And looking forward, that's 18 at an 18% free cash flow margin. So decent margins, decent growth, pretty cheap valuation, pretty reliable. Overall, I would give Uber, I don't know, I want to put them in B, but all the numbers look pretty good, so I would put them in A. Maybe I want to discount them a little bit because of their unpredictability. We don't really know what's going on with robotaxis and with Uber and Zoox and Tesla and all of that. It's unsure what their market position is going to be going forward. And maybe they will have to change the way they operate their business to adapt to this new situation. And then it's unsure if they can keep their profitability. So maybe I will put them down into B tier. If everything goes well, they are an A, but it's just not entirely sure right now. I think that looks pretty much fair, actually. I'm fairly happy with what I just did, which sounds absolutely terrible. Yeah, I think this pretty much reflects the way I think about my holdings. Let me know in the comments down below if you would change anything right here. And of course, keep in mind that I didn't spend incredible amounts of time going into detail on each company. So maybe there are some reasons in my head that I didn't say because it would have taken too long for me putting the company where it is. But yeah, if you disagree anywhere, let me know in the comments down below. Also, if you think that you know about some growth stocks that should absolutely be on this list and also my portfolio, let me know in the comments down below. And thank you guys so much for watching, and I'll see you in the next one.